I'm Roger Montgomery and welcome to this week's Video Insight. I've just written and published a blog post suggesting a significant amount of deterioration in jobs and earnings needs to occur for the world's most predicted recession in the United States to happen, one that justifies interest rate market expectations for more than 3 rate cuts before the end of January 24, which is in just 7 months' time. For those rate cuts to transpire, we may also need inflation to plunge from its current annualised rate of 3.6% to around 2%. But even if that happens, the Fed might refrain from cutting rates until it sees something else is breaking, like the economy or earnings. As I reported in my blog post, US quarterly earnings season is heading towards 3/4 time, and earnings growth is negative 3% year on year. Now that's a solid 6 to 9% better than what was expected, and it suggests jobs are secure and the economy is not collapsing towards a recession. To be fair, the dodgier results tend to be reported late, but I can't imagine a deterioration from the final quarter of companies significant enough to meet the pre-reporting season growth expectations of negative 9 to 12%. And in any case, even if earnings were to decline, it's not guaranteed that the market would collapse. And that's what this video is about this week. When it comes to investing in equities during anything other than a raging bull market, it seems there's always something new to worry about, something that hasn't happened but is likely to make investing now too risky. Right now, that's the most obvious and predicted recession ever, and a commensurate collapse in earnings. As I just mentioned, earnings are holding up relatively well. But if they fall, what happens to prices? As you would well know, prices had come down a long way into December last year, and now they're rallying. But what happens if sales and earnings or cash flows fall? That's what many investors are concerned about. Well, it turns out the relationship isn't as clear as you might expect. One analyst took the time to examine historical data from Professor Robert Shiller, comparing earnings growth by decade to US stock market returns. In the 1930s and the 2000s, there was a high level of correlation between the stock market and earnings. Both collapsed. In the 1940s, the 1990s, and the 2010s, the market surged a couple of 100%, along with soaring earnings. So there was high correlation there as well. But that's where the positive correlation seemed to end. The 1970s saw superb earnings growth, but a return of about 4.5% for the S&P 500. The following decade, the 80s, the market surged even though earnings didn't, and that was repeated in the 1950s. Some of you will be saying, that's all very well over decades, but I don't have decades. So what about shorter periods? Looking at the 91 years from 1930 to 2021, S&P 500 annual corporate earnings were positive 61 times and negative 31 times. And once again, the market's rises and falls don't correlate perfectly at all. If you knew in advance that earnings would rise and only invested in those years, your return would have been 10.1% per annum. And yet, if you only invested in the years when earnings fell, the average annual return would be 9.8%. Of course, to achieve that result, you'd have to have invested in all 31 negative years, and there would be some absolute shockers in that group. And how about this interesting fact? Over the 91 years to the end of 2021, the S&P 500 saw more positive years, more double-digit returns, as well as years of greater than 20% returns when earnings were down from one year to the next. Double-digit losses were also more likely, hence my comment that achieving the average return would require a seriously strong stomach. So you achieve a higher return investing in years with positive growth for earnings, but it's only marginally higher than investing in the negative years. The real benefit is the lower volatility of returns. And keep in mind, the biggest market collapses in the last 100 years have correlated with substantial earnings declines. But in the absence of a recession, which the interest rate market seems to be predicting, but Jerome Powell of the US Federal Reserve is not, it seems a substantial correction in earnings is unlikely. And even if earnings decline further than what seems to be a current rate of -3% year on year, there is no certainty the market will slide. In fact, it's worth remembering right now, earnings are indeed falling 3% year on year, but both the S&P 500 and the Nasdaq are up for the year. The S&P 500 nearly 10% and the Nasdaq nearly 20%. Well, that's all we have time for this week. Look forward to talking to you again next week. And in the meantime, please follow us on Facebook and Twitter.